Reform Act, Congress has said that we have got to 1099 everyone for not only services, but for products that we purchase.
You're
For
kidding
example,
me.
no, this is only for businesses, though. It doesn't mean corporations. It means any business.
Okay.
So that means that if we go to Target and we go out and get some supplies for our business, we have to 1099 Target,
You got to be
regardless
kidding
of whether
me.
it's a corporation or not. No, this is one of those things that it was really deep inside this Reform Act,
Okay.
and right now it's being discussed back and forth to take that away, because
Okay.
this would just be an extreme burden on a lot of businesses.
Right, right. Or accounting fees would just go through the roof, man, trying to track all
Absolutely.
that.
Well, believe me, we don't want to do this.
Right.
This is just one of the things that no accountant wants to deal with.
Now, are you sure, John? There's no accountancy lobby in Washington. You guys are trying to get more
Gosh, we
fees
do have
from
a
us.
lobby, absolutely. The AICPA, the American Institute of Certified Public Accountants,
Right.
is lobbying out there for us. But believe me, they're not lobbying for this. That's for sure. We're
So-
lobbying against it, in fact.
So you go to Target or any store to buy supplies or whatever you need for your business. You got to issue a 1099 to that company.
Exactly. Everyone. And see, what this is doing is, I think it's moving towards some sort of taxing authority like what Mexico does at this point, where they show all the invoices to their IRS every year.
Okay.
So I don't think this is going to pan out, but oh my gosh, if it did, it would be an extreme burden on everybody. And
Right.
also the IRS. The IRS would have an extreme burden on this as well.
Yeah, they would have to double their size. I mean, just
Easily.
to manage all this. So, John, going back to investors or landlords, so this is effective now that in 2011, all the expenses we have on investment properties, we need to get W-9s from these individuals we're paying to manage or to, repair or keep up these properties. We have to issue 1099s. Otherwise, we may not be able to write any of that off. Am I clear on that?
Absolutely.
Wow.
You are absolutely clear on that. So for audits, you need to 1099 all of these people for 2011, which means that the 1099s would have to be issued out by January 31 of 2012.
Yeah, that's
which
right.
is 1 month after the end of it.
There's a penalty, too, right, if you don't issue it out by January 31st, right?
Exactly. There's a $25 penalty for each 1099 that you don't send out to the recipient on time. I've yet to see that penalty imposed. I honestly haven't seen it in all of my career, but it is on the tax code.
I see. Okay. All right.
A lot of things here. The last business act that I want to talk about, or the relief act here, is the Small Business Jobs Tax Relief Act of 2010. This one was really neat. This is good stuff for a lot of small businesses that are looking for SBA loans. The SBA, whenever you either acquire a commercial building or looking for a loan of some sort, even if it's just working capital, will charge you an SBA fee. The SBA fee, from what I understand, it's anywhere between 2 and 3% of whatever your purchase or your loan amount is. Well, what the Small Business Jobs Relief Act did is it gave you a credit and reduced significantly this fee. And for some of my clients that were buying buildings this year, that made anywhere between a $60,000 and $80,000 difference to their outgo. So that's a big deal. Also, in the Small Business Jobs Relief Act is the health care credit. This is not to be confused with the Health Care Reform Act credit. This is a little bit different. This means that if you have under 24 employees, full-time employees, and they average out of being paid $50,000, you could get up to a 35% credit, which means dollar for dollar back in your pocket, of all of the health insurance that you've paid for them.
Okay.
This is really neat. For a lot of small businesses that are already paying for health insurance, it can really help them get a good chunk of a refund back.
Okay. Well, that's some good news. I'm glad you're ending these three big bills on a high note.
Absolutely. There's just so much bad news in here. I mean, there could, if these acts were not extended from the Bush tax cut era, this would be extremely bad news.
Yeah.
I mean, for some of my clients, they would wind up paying anywhere between 40 and 50% higher taxes than what they paid in the previous years.
Okay.
This is extreme in a bad economy. So those are the three acts that I wanted to talk to you most about. And I wanted to round back up one of the conversations that you and I have had on the Power Is Now are the foreclosure and short sales.
Okay.
Nothing has changed for those in 2011 and 2012 for both California and federal government.
Okay.
I want to run those by really quick here. We have what's called Section 108 exclusions, the tax code that basically says, well, the IRS doesn't want to kick someone when they're down, so we're not going to tax anything if they were in this particular situation. And just giving you a little bit more background is that whenever you have a short sale or a foreclosure, it's because you can't pay the mortgage. And the mortgage itself is higher than what the value of the property is.
Right.
The difference between the value of the property and the mortgage is a discharge of debt.
Okay.
And discharge debt for IRS purposes and California is considered income to the individual. Mm-hmm. That income is taxed to you, and there are some exclusions as to where you do not have to pay taxes on this amount. The first one is the 2007 Mortgage Relief Act that was signed by President Obama, that basically said that if you had not refinanced your property, in other words, this is original purchase money loan, then you wouldn't have to pay any taxes so long as the property value was less than $2 million. California came behind that and said, okay, we agree with that, but we're going to make this into a discharge amount of no more than $500,000.
Okay.
So that if you short sold or foreclosed on a property that had, let's say, $300,000 of discharge in debt, negative, mm-hmm. then you wouldn't have to pay taxes on any of it at all for federal or California purposes.
Okay.
But let's say that you had $600,000 of discharge of debt.
All right.
That means that for federal purposes, no taxes because it's under $2 million. But for California, they would exclude the first $500,000, and you would have to pay taxes on $100,000 that's left over.
Wow.
And mind you, this is only for purchase money.
Okay.
The next is insolvency, where the IRS allows you to calculate how much assets you have before the short sale or foreclosure and how much of liabilities you have outstanding at that time as well. If you compare both of these amounts, if you are negative on that, to the extent that you are negative, that would be your exemption of income. For example, let's say you added up all of your assets and they got to $600,000.
Right.
You added up all of your liabilities and they came out to $900,000.
Okay.
The difference between those two is $300,000, mm-hmm. and that would be your exemption to the short sale. So if the short sale was only for $200,000, discharge was only for $200,000, you're fine.
Okay.
If it was for $400,000, then you would only exclude the first $300,000, and you would wind up paying taxes on the rest of the $100,000.
Okay, so that's the state's formula for still, getting some money in the situation, whereas the federal government is saying we're letting you off the hook completely.
Absolutely. Well, I just had one of my clients that short sold her property that she originally bought for $1.8 million, mm-hmm. but she had borrowed $4.2 million on this.
Oh, my goodness.
And you can see that it definitely doesn't fall under the 2007 Mortgage Relief Act.
She paid $4.2 and
she had borrowed $4.2. So she bought it originally for $1.8, and the property went up in value.
Okay.
And now she owed $4.2 million on that, and therefore she doesn't have any relief at all.
Right. I see. Okay.
So those are the issues. It's always a good idea to talk to your CPA, your tax advisor, before you get into any of these issues. And as real estate agents, it's a good idea to have your client talk to a tax advisor ahead of time,
right,
before they actually go through this, mm-hmm. because you would hate to be who's left over with the idea of, hey, I didn't know this was going to happen to me. Why'd you let me sell my house at this point?
Mm-hmm. No, you're right.
So. Third is the tax attributes. If you have another property besides the one that is being short sold or foreclosed, it's possible that you might work in this discharge of debt into the other property and basically defer the taxes on this issue if the second exception to the rule didn't affect you. And then finally, the bankruptcy. If you're in the middle of a bankruptcy within the foreclosure or short sale, the IRS, well, that obviously is the definition of insolvency, so there's no taxes at all.
Does it matter what type of bankruptcy it is?
No, it does not. It can be a Chapter 13, a Chapter 11, a Chapter 7. So long as you're in the middle of a bankruptcy, there is no discharge in debt for tax purposes. You're just completely off the hook.
Wow. That's a viable alternative for a lot of people then.
Absolutely. And again, a very good idea from what I talked to a good tax professional before they actually sign off on the dotted line or before they're kicked out of home in a foreclosure.
Sure.
So going to tips to organize.
Okay.
Well, gosh, we get so many clients that just give us the shoebox sort of thing, and we try to figure out a best tax solution. But really, it's hard to do that without some sort of organization. And the organization not only helps your tax preparer or tax professional, but it also helps you as the individual to understand what's going on through your business. Some tips to organize: QuickBooks, some sort of accounting. This is our business, everybody, and we've got to understand what kind of ins and outs are going on, whether or not we should change anything that we do in our business into more profitable for us and our families. So the first tip for organization is set up some sort of accounting system like QuickBooks. I know we set up QuickBooks for our clients all the time and them run it on an annual basis. That way they at least know what's going on in their business.
Now, John, the challenge is that realtors can't find the time to do the actual, collecting of all the receipts and all the, all the expenses and entering in that information in the system. How important do you think it is? I guess it maybe depends on the realtor's level of production, how much money they have to invest, but how important is it to maybe hire a bookkeeper to handle these things for you?
Well, Eric, it is vital. Put it this way, it's very important, because if a realtor is not going out there and producing very much, they to ask themselves why am I not producing? Where am I spending not only my money but my time? I think it is vital to any business to understand what they're putting into this game. And it can be dollars or it can be time. I mean, if we're spending so much money going to the restaurants, but we're not getting any business out of it, maybe we should scratch our head and think, well, was that even worth it? Or if we're going to all of these seminars and they're not having anything to the bottom line,
right,
you got to ask yourself, is this really the right way to go? And it doesn't necessarily answer the question, but it pops up the question of, let's think about this. Is this what we really should be doing? Now, someone who's got great sales rarely asks the question as to whether this worked or not, because obviously something's working. But again, it's vital and very good information as to, am I wasting money here? Where were the dollars that I've used really impacting my bottom line?
Yeah. So you don't really recommend a realtor try to do the bookkeeping themselves unless they really do have the free time. They should hire someone, don't you think?
Absolutely. Yeah. If they don't have the time, then they definitely should hire someone to do that. And here's what a really good bookkeeper will do, is they'll look through all of the banking accounts, credit card accounts, and be able to sort through and organize a lot of your receipts.
Yeah.
Wow, if you ever got audited, you just call onto your bookkeeper and say, can I have copies of all of what you just took care of for me? And the audit would just go very swift. So if you were ever audited. So that's my second tip, is keep all of your receipts.
Right.
Even if you chose not to have a bookkeeper, open up a manila envelope, put them all in there, and be done with it. But don't throw any of your receipts away. Try not to pay for anything in cash, because if you pay for things in cash, it's hard to substantiate those expenses.
Right.
Number 3, keep a mileage log. Most people think that, well, I'll get a mileage log together if I ever get audited. Well, gosh, when you do get audited, you forget where you went. It's too late from that point. And not only that, this is a really good tracker for leads as to, well, I went out to this place, that place, and really, how am I spending my time and my resources?
Right.
So again, very, very, not only for organization for tax purposes,